From Kansas State University, this is Agriculture Today. Eric Atkinson with you, and here's today's lineup. K-State's Dan O'Brien will comment on the grain market's interpretation of yesterday's USDA World Grain Supply and Demand Report, and Dan will remark on the unrelenting strength in wheat prices as harvest time in Kansas is near. Following then, K-State's Gregg Ibendahl is back, this time sharing his latest analysis of Kansas farm income data, this time focusing on the impact of non-farm income on the financial state of family farms, and breaking that down even further, looking at the financial latitude that non-farm wages create for farm families. And to talk Kansas agricultural weather with us later on, K-State's Mary Knapp, plus more for you here on Agriculture Today. This is Agriculture Today, and thanks for being along with us once more. The USDA yesterday issued its June World Agricultural Supply and Demand Estimates report, which of course contains information of high interest to the grain markets, and that will be one of our lead themes as we go over the grain market trends once again with Dan O'Brien, grain market economist, K-State Research and Extension, from his office in Colby. So we'll walk through the stocks numbers here, Dan, but let's begin with corn, and the number in general there quite short of expectations, and the market responded accordingly.
Yeah, I think it's really the surprise of the report, and probably the most price impactful item of information that came out. Of course, in this setup for supply demand usage across crops, if you shock the corn supply demand balance sheet in the corn market, it affects everything else. So pre-report expectations for projected ending stocks for old crop 2020-21 marketing year, what will finish August 31st, were basically an average of 1.205, a low estimate of 1.132 billion bushels. The USDA's numbers came in on the strength of twin 75 million bushel increases in ethanol usage. So usage increased by 150 million bushels. Ending stocks decreased by that same amount, all else held equal, down to 1.107. Again, below the bottom end of what any trade analyst was expecting. So with that, it's just interesting. We pay so much attention to these benchmarks. July corn closed at $6.99. Not 7, but $6.99, up 8 cents, and interesting to see that impact on the market. We're also watching new crop Dees corn, and anybody that hasn't sold old crop supplies yet at these lofty, tremendous prices is wondering about what to do on the new crop side. Dees corn at $6.16.5 on yesterday's close. I hear a lot of discussion from grain market analysts who are very aware of the typical patterns we often have in these years, where if we start to get rainfall, et cetera, then from really early June highs, we start to be vulnerable to prices falling off. So we're at that point. Boy, it's quite the debate back and forth. Is this a year where we would see that happen? I think if we saw weakness in usage and saw rains coming that would give us large supplies, then you'd be more likely to see that than we are right now. Again, we've got strong usage. You and I talked before we aired about what's happening on the ethanol side. Well, if you look at ethanol charts, we're up to a close yesterday of $2.46. And on May 1st of last year, we were trading at $1.20.
Wow.
And that has all to do with the U.S. economy, traveling happening in the summer, the economy doing okay. We have our worries and fears about inflation, et cetera. But so far, we haven't had those things, quote, come home to roost. So you have that happening. And then on the export side, we had, for corn exports this last week, actually had shipments the week ending June the 3rd of 65 million bushels. And we need, even after the USDA made these changes that they had done, again, increased export estimates for this year up to 2.85 billion from what they were last month, 75 million increase. We need just 64 to make the pace. So even with the with the ramped up expectations now for corn exports that have come out in this June report, we still have a pace this very week that's above what the implicit amount that we would need to get to the end. And think of the ramifications, Eric. What if that's too low? And we're sitting at 1.1 billion and stocks to use below 10. And what if it's 50 or 100 million short yet of where we do end up with strong pace? And we have news reports. Brazil is importing corn from Argentina. They're tight enough. They're the other major importer in the world. Of course, to them, it's part logistics, where's the corn located and timings and all. So anyway, what's my point? Point is that there's evidence out there, absent tremendous rains coming and bailing the whole situation out, of prices still reflecting a lot of worry about production for a good amount of time here yet. And again, if we have some combination of tighter supply with strong usage, we get down to 1 billion bushels or less carryover. And that's, given that we use about 14 to 15 billion, that's just awfully tight and would surely hold up price options for corn for a good while.
It surely sounds like the fundamentals are there to favor staying power in the corn market. Before we move on to soybeans, let's quickly refer to grain sorghum and what's happened there with stocks, and moreover, what's happening with local price trends in Kansas.
No changes in this supply-demand balance sheet. Continues to be a noteworthy thing to look at to see the strength of new crop forward contract bids for grain sorghum here in Kansas. In this last week, a range, the low end of 621 per bushel in southeast Kansas, everything else from 667 to 681, 682, those numbers are about 50, 60 cents higher than for corn. So there's anticipation of exports. And I would say also in the cash market, spot bids for sorghum had fallen off about 50, 60 cents below corn bids after being way above them earlier. But then here this week, again, this often happens in central Kansas when you're wondering who's got a contract to fill or who wonders what business is coming down the road on the export side. In the Atkinson area, you've got a jump up in the cash price, the current cash price for grain sorghum up to $7.19. That's the top bid in that area. The top bid for corn in that area is $7.08. So both are tremendous. But here you've seen sorghum really jump up. In essence, somebody wants to get whatever grain sorghum's out there because they've got something happening, and it's probably a train to fill. So for those that have old crop grain sorghum yet, again, that's a price signal that hey, export demand is not dormant. And also, by the way, when we get new crop in, people are anticipating there'll be a lot of it.
Back to that WASDE report, as far as soybeans went, the stocks numbers there leaned bearish, Dan, and the market did move to the downside, but proportionally very little, which may have something to say about the resiliency of the bean trade, too.
Bearish to a degree by 15 million bushels. And in essence, we shaved some usage off of expected crush. By the time we get to end of August 31st, we were at 2.175 billion bushels for what the USDA projected, down 15 million from where we were at 2.185 coming out of the May report. So I guess my question would be, how come it took so long? Because with the strong pace of soybean exports, you could just see domestic crush and exports battling it out for whatever was left on the supply side. Again, we have ending stocks projected at 135 million bushels in old crop and projected to be at 155 for new crop with all that uncertainty about the size of this coming crop yet. So I don't want to just poo-poo that thing and say, well, it's not anything big, but yeah, it's a little bit bearish. We've raised stocks a little bit, but the market with that change didn't just fall completely into the crevasse on that. It basically, with that outcome, dropped 18 cents yesterday after the report came out. We've had bigger moves just on daily news in the last 2 or 3 or 4 weeks. So a little bit bearish, but I guess I'd hesitate to call it bearish. It's more almost a rebalancing thing. The bigger issues that are out there still have to do with the size of this year's crop and getting us through what our usage needs are until we can start to see new supplies come out here in the early fall.
And we have to talk wheat, of course, and the stocks numbers from the USDA yesterday as well. All of this lends to that pressing question, will these prices that are attractive, to say the least, hold up well into harvest as we're knocking on the door of test cutting?
Well, I would say when you look at hard red winter wheat futures over the last 2 weeks, they have not gone down, and we're starting to harvest. And yet we've had, for exports, okay exports, but nothing gangbusters. This week ending June the 3rd, we had 5 million bushels of actual hard red winter wheat shipments. Need about 17 and a half to meet the USDA's pace for this marketing year. And in the midst of all that, in essence, moving sideways in the wheat market. And this is at the same time, in the NASS report, they raised the numbers of expected size of the hard red winter wheat crop here in the U.S. I think soft red was up too. So we have enough other maladies around, particularly to the north with hard red spring, that's lending cross-market support, sure seems like, to hard red winter wheat. And also, again, the tightness of what's happening in the feed grain market with corn also supports wheat as well. One thing for us to watch now, yes, we've got the WASDE report out of the way. Now we look to the end of the month quarterly stocks report, and that's supposed to have been measuring what was happening June 1, about a week ago. In that report, for corn, for sorghum, for wheat, we'll be watching for evidence of feeding of those commodities going on. And so on June 30th, I think it just behooves people to be thoughtful about what their cash market positions are heading into that report.
We will steer folks in the direction of your weekly notes on the grain markets at agmanager.info. Dan, thanks for joining us once more.
Thanks, Eric. Take care.
Dan O'Brien, grain market economist, K-State Research and Extension, with his weekly installment on the grain trading trends here on Agriculture Today. Agriculture Today is back now on the K-State Radio Network. And once more, we're digging into more information that our guest has put together and posted on the agmanager.info website. We've been talking with K-State farm management economist Gregg Ibendahl about his various analyses of the net farm income numbers out of the Kansas Farm Management Association. And he's been stringing together all sorts of trends, including those affecting the family farm expenses directly. And it's toward that end we go once more. Gregg, in the latest 2 articles that you have authored on family living and non-farm income, and then taking that one further, looking at non-farm income versus non-farm wages. We'll pick up on what that means in just a moment. But you wanted to get a notion of how much non-farm income streams contribute to dealing with family living expenses on the farm?
Yeah, I think that's an important issue to look at if you're a farm family, because as we showed in our earlier paper, family living for farm families is about $70,000 per year, which is pretty much typical really for all families. So, and if you go back and look at our net farm income from year to year, now this last year, obviously we're well above that, but you had to go back to maybe 2015 or 16 when we had net farm income down to $5,000. So, in a lot of years, net farm income is not going to be enough to cover family living. So that's why when we really look at family living for farm families, we need to also consider the non-farm wages and non-farm income as a source to meeting those family living expenses.
That really hasn't been firmly quantified up to now then, and that's what prompted you to do this?
Well, I'm not sure really how many people really have good data about that. So, Kansas, obviously, with their KFMA program, and Illinois with their FBFM program, I think we're probably the 2 main states that really have a good handle for what's going on here. So, we, in any given year, we'll have about 1,000 farms that are usable in our KFMA data we can use for whole farm analysis. Well, a subset of those farms also keep track of their family living, and we probably have about 300 to 400 farms there that we can actually go back and then look at the family living side of things as well.
And you do have the new numbers from the association for 2020 to work with here, defining what non-farm income is exactly.
Yeah, so looking at our analysis here, practically every farm in our analysis does have some level of non-farm income. So that would include non-farm wages, but it's also going to include things like interest income. We have some farms in the state, obviously, with some oil and gas production, maybe some wind energy things, a whole set of things. And all those contribute to our non-farm income that we can add back then to our farm income and look at, is that enough income actually then to cover our family living expenses?
So you went at this, you mixed and matched the numbers, and were you able to define just how much non-farm income does contribute to covering those family expenses?
Well, it contributes quite a bit. So if you look at my one graph in the paper that will be up in Ag Manager, basically our median and average numbers are probably about $60,000 or so for non-farm income. So there's quite a bit of income that comes off outside the farm. And again, that could be a spouse working. It could be a part-time job for the farmer. It could be some oil and gas money coming in, things like that. So there is a fair amount of money coming in, which is good because, as I mentioned earlier, the variability in net farm income can be quite a bit from year to year. So this certainly helps to stabilize things and definitely helps farmers to get by in those years where the net farm income is pretty low.
That really is the message that you come to in this one analysis, and that is those non-farm income sources do make a difference in helping folks get along with their family living from year to year with some consistency.
Yeah, I mean, if you look at the one graph I have, I basically looked at the ability of when you add net farm income and non-farm income together and then subtract off family living. We want that to be a positive number because that's going to be some measure of how you're covering family living expenses. And it turns out, I would say in most years, we're probably going to have maybe 25% of the farms that may struggle with that a little bit. Now, luckily, it's probably not the same 25% of farms every year, but there's going to be a set of farms every year, even the good years, that are probably going to struggle a little bit. But if you look at kind of our average and median values for that measure of looking at net farm income and non-farm income and the taking away family living, I would say if you just look at the average, most farmers are doing that on a year-to-year basis, which is good.
Well, that was the first of the two articles that you have authored and posted on agmanager.info. Now you mine a little deeper here and you look at non-farm wages as part of this pie and need to sort out the verbiage here. This is not the same as non-farm income, so you might differentiate.
Yeah, so non-farm income includes all income that comes outside the farm. The non-farm wages then would be a subset of that. It's those farms actually have off-farm employment that, pays a paycheck on every month or every 2 weeks or whatever that would come back to the farm. So that's going to be a smaller set of farms. And that made it a nice analysis for this second paper because I could divide those farms into two groups. I could look at the farms that have, a fairly good size amount of non-farm wages and those farms that have minimal or no non-farm wages. I used $5,000 for my cutoff. So when I did that, basically 2/3 of our farms basically have non-farm wages above $5,000 per year, and the other third either have no non-farm wages or non-farm wages under $5,000.
And then you try to decide whether that makes a difference in the net farm income picture here. How did you get at this, and what did you discover?
Well, one of the first things I looked at was saying, do those farms with no off-farm employment, do they actually make more net farm income? And you might expect that might be that was my hypothesis, that if you didn't have off-farm wages, you probably had a higher net farm income because you needed to get all your income from one source. And that actually turns out to be the case. It's pretty consistent if you look from 93 to 2020 that those farms that don't have off-farm employment, they typically tend to have a higher net farm income in year to year because they don't have that off-farm income source to rely on.
They don't need to go that route in a lot of respects.
Yeah, no, they don't. That certainly doesn't eliminate all variability, but as far as looking at the average amount of income over time, their higher net farm income is on average higher than what net farm income is for those farms that do have off-farm wages.
But you say in your write-up that the non-farm wages bring two important elements to the table here.
Yeah, I think so because, there's probably a couple of reasons why farmers have someone working off the farm. And one of the big factors in that is the ability to cover medical insurance needs because a lot of off-farm employment will cover that as one of the benefits for that. So that would be one big benefit. And then if you do have non-farm wages, I think that eliminates a lot of your income variability from year to year. And if you have less variability in your income, you're probably more likely maybe to spend some more money in a given year than you would otherwise just because you have a kind of a backup source of income coming in. So I was kind of looking at both of those factors in my analysis as well.
Something else that you brought up in our last visit, too, as far as family living expenses, and one of the prime categories there, recreational expenses, and you could lump in entertainment expenses there, too. The non-farm wages will impact those.
Yeah, it almost looked to me like that's the case, and I think there's possibly two explanations for that. So if you go back and look at my one graph in the paper, those farms that have wage income, they tend to have probably $2,000 or $3,000 more dollars in entertainment and recreation than those farms with no non-farm wages. And I think there's probably two factors going in there. One is that they do have more stability of income, so that maybe they're more likely to spend more on entertainment and recreation, because that is one of those discretionary categories you can cut back on. But the other factor, I think, and maybe this is maybe even more important, is that the fact that they do spend more on entertainment and recreation probably means they don't have to spend as much as in another category. And the most obvious category to look at for there would be look at the health insurance side. And if you look at that one, there's a really big difference between those farms with wages and those farms without wages.
The big difference there?
Well, so if you look at my one graph in the paper, it's almost in every single year except for maybe the last year or two where those farms that actually have non-farm wages, they're paying significantly less in health insurance, probably on the neighborhood, probably maybe to a fourth or a third less than what those farms are that don't have wage income. And again, a lot of that, I'm attributing a lot of that probably to the fact that those farms that actually have non-farm wages probably are getting some of those farms at least are getting their health insurance covered by their jobs.
So when you consider all of these numbers and these trends that you have identified, Greg, what does this say about the importance of non-farm income broadly and wages from non-farm sources more directly?
Well, the one thing I was a little bit surprised about when you compare my ability to meet family living with your combination of net farm income and non-farm income, really, those farms with wages and non-wages, they were almost identical when you look at those two graphs. In each case, you still had about 25% of the farms that were struggling a little bit to meet family living in a given year. Again, it may not be the same set of farms, and on the average, probably most of them were in every single year. But as you mentioned, whether you're just talking about non-farm wages or whether you're talking about non-farm income in general, that's a pretty important factor in the ability to meet family living because net farm income is so variable. So I think a lot of farmers would have a lot more years of really struggling if they didn't have this kind of backup source that kind of helps evens out their overall income from year to year.
Well, this really sheds some important light on an aspect of farm family economics that tends to go somewhat overlooked once again, but it is a vital component for so many family farm operations. That is the income that is drawn from off the farm and how it contributes to the overall farm economic picture. And you can read more about what Greg has put together here in these two articles. One entitled Family Living and Non-Farm Income, the other Family Living and the Connection to Non-Farm Wages, both at agmanager.info. Once more, good work in sifting all of this out, Greg. Thanks for telling us about it.
Yeah, thanks.
He is farm management economist Gregg Ibendahl of K-State Research and Extension, who is routinely tapping into those Kansas Farm Management Association numbers and depicting trends of importance to farmers and ranchers. We'll be back with more on Agriculture Today. You're tuned in to the K-State Radio Network and Agriculture Today. Eric Atkinson back with you, and on to today's agricultural news page. And these headlines, courtesy in part of DTN. Well, as part of that World Agricultural Supply and Demand Estimates report out yesterday, the USDA did post its June winter wheat production forecast. It shows yields up from the previous month, yet varying by regions of the country. Here's more from the USDA's Rod Bain.
USDA's latest winter wheat production forecast shows a 2% month-over-month increase in this season's crop. Also up in June, crop yields, with the number of bushels per acre reported at 53.2. That's a 2.1% rise from the previous month and currently serves as the third highest yield total on record. Yet Agriculture Department Chief Economist Seth Meyer notes changes in yield differential across the country.
You can see some pretty noticeable increases in places right on or east of the Mississippi. But when you look at the upper west, where it's been incredibly dry, they made some rather large downward revisions in yield there as well.
There were no changes in planted or harvested acres, as surveys are being conducted at this time for USDA's June 30th crop acreage report.
Last month, they forecast that the harvested to planted area would be the lowest in a couple decades. They, of course, don't change that ahead of the acreage report, but there will be a lot of eyes even on that aspect of the June 30 acreage report.
I'm Rod Bain reporting for the U.S. Department of Agriculture in Washington, D.C.
Now, based on June 1 conditions, Kansas' 2021 winter wheat crop is now forecast by the USDA at 359 million bushels, up 28% from last year's crop. According to the National Agricultural Statistics Service, the average yield now forecast at 52 bushels per acre, up 7 bushels from last year. And that was up the report from 331 million bushels the USDA forecast in May. They forecasted then as well a yield of 48 bushels per acre last month. And for comparison purposes as well, looking at these numbers alongside the hard winter wheat tour of Kansas and surrounding states last month, that tour projected a crop of 365 million bushels on a yield of 58 bushels per acre. A federal judge in Wisconsin has now ordered the USDA to at least temporarily halt as much as $4 billion in loan debt relief payments to minority farmers in response to a lawsuit filed by farmers who were not eligible for the same debt relief. The case, just one of at least 5 federal lawsuits now filed against USDA Secretary Tom Vilsack to block the USDA from paying off loans for minority farmers without also paying off loan debt for other farmers. U.S. District Judge William Griesbach issued a temporary restraining order yesterday blocking the USDA from paying any loan debt to socially disadvantaged farmers, while the U.S. District Court for the Eastern District of Wisconsin considered a more extensive preliminary injunction request filed by attorneys for 12 farmers and ranchers from several states who had joined a lawsuit against the USDA's debt relief program. The plaintiffs in the case would each be eligible for loan forgiveness under the program except for their race. Now, the USDA had announced in late May that the department would start paying off as much as $4 billion in loan debt immediately for as many as 16,000 minority farmers and ranchers. Under those loan provisions, the USDA would pay off the debt for those farmers for FSA direct loans, guaranteed loans with private lenders, CCC loans, or farm storage facility loans that had a debt balance as of January the 1st of this year. This lawsuit was filed by a legal group, the Wisconsin Institute for Law and Liberty. Texas Agriculture Commissioner Sid Miller filed a similar lawsuit in the state of Texas over the loan program, and at least 3 other cases have now been filed against the USDA in Florida, Tennessee, and Wyoming, asking for injunctions against the department from moving forward with this loan debt forgiveness program. Now for you, this week's edition of the Kansas Wheat Scoop. And with that, as always, is Marcia Boswell. Marcia?
Inspired by American classics like peanut butter and jelly and cinnamon rolls, Anna Barth infused Thai flavors into her family's favorite recipes to create her winning recipe for the 2021 National Festival of Breads, Savory Thai Peanut Sauce Rolls. According to Cindy Falk, co-chairperson of the event and nutrition educator for Kansas Wheat, the dynamic flavors and soft texture of these savory Thai peanut sauce rolls made Barth's recipe a judge favorite. Our recipe evaluators highlighted how the rolls were light as a feather with a melt-in-your-mouth combination of sweet and savory flavors. Barth, a resident of Long Beach, California, was crowned champion as the 2021 Best of Breads champion during a virtual event on June 9th. She receives a year's supply of Red Star yeast, a year's supply of King Arthur flour, and a $500 King Arthur Baking Company gift card that can be used toward a baking class. Like many across the country, Barth, an administrator at the University of Southern California, was grounded this past year during the pandemic. She used that time to bake more desserts and bread for her family, bringing the flavors of her Thai heritage into classic recipes as she mastered them. This roll recipe was Barth's first ever entry in a baking contest. The peanut sauce used for the rolls is commonly used as a dipping sauce in street food in Thailand. When she made the sauce at home, her husband started putting it on bread as the peanut flavor in his peanut butter and jelly sandwiches. She also incorporated other Thai flavors for her entry, including Thai red curry paste and coconut milk. Barth said, "The red curry paste, that's pretty unique for rolls that you see in this country. Also, using coconut milk as one of the ingredients brings the Thai-ness into the rolls." By having the peanut flavor in the recipe, it gives the feeling of familiarity for the people who taste it. It tastes like you are having peanut butter, but with a kick. After the sauce is refrigerated, she likens the consistency to the filling for cinnamon rolls, which is easily spread onto the master dough recipe. The dough itself was developed using a Tangzong starter, a common technique that Asian bakers use for soft breads to make the rolls soft and fluffy. In addition to the Thai ingredients, the recipe also uses high-quality King Arthur bread flour and Red Star active dry yeast to bring the rolls to perfection. Including Barth, recipes submitted by 3 adults and 2 youth finalists representing states from coast to coast were handpicked to be featured during this year's virtual festival. Learn more about the other finalists and more about the contest at nationalfestivalofbreads.com. For Kansas Wheat, I'm Marcia Boswell.
Thanks, Marcia. As we'll hear from Mary Knapp in a few minutes, rain is on its way over the next 12 hours or so, and let's hope it's just rain. Kansas agricultural weather next on Agriculture Today. Coming your way now on Agriculture Today, the very latest out of the Weather Data Library here at K-State. For along to talk Kansas agricultural weather with us once more is Research and Extension climatologist Mary Knapp. This past week, Mary, open weather for field work. Extremely welcome despite the heat for producers.
Right. Well, and when you talk about heat for the producers, it should be noted that most of that has come in the last 2 days or so, and it hasn't been as extensive out west as it has been in the east, which is kind of a switch where you're more accustomed to having those high temperatures in the west and they cool down at night. In the east, it's usually a more even temperature, a little bit warm during the day and not quite as cold at night. But it's been kind of the reverse with that. When we look at our drought week, which ends on Tuesday, it actually fared as being slightly cooler than normal. But, of course, the last couple of days have put an end to that. We've reached 90 in Manhattan finally, and actually above 90 yesterday. Haven't hit the century mark, and that's okay. We're perfectly fine to put that off for a while. So, again, a little bit on the cool side, but the most notable, as you said, was that we were dry, and that has been very welcome given the rains that we had to end May and start June. We weren't totally without events. There were a couple of isolated showers, which are the common form that our showers will take during the summer. Near Canopolis Lake, they actually had almost 2 inches of rain, which is enough to keep some people out of the field a little bit longer. But there's been a lot of progress made towards getting the corn planting finished off, getting the beans planted, getting the milo or sorghum, however you want to call it, into the ground as well. And probably also notable is that that stretch of dry weather has allowed the hay to get up. That has been a lingering problem this spring. Some people never got their first cutting. Right. They had to go straight to what would be a second cutting, and that, of course, impacts the quality. So we're not complaining yet about the dry weather.
It's been busy across the countryside. Any shift then in the drought monitor for this week?
This week there was not. Last week we had the major improvement from the May rains. We still have a lingering pocket of abnormally dry in the northeast and another one on the boundary between southeast and south central Kansas. If the forecasted rains don't materialize, we will see those expand very quickly. As you noted, we've gotten back into the warm weather. That's going to dry things out quickly. A lot of the crops are in their most aggressive development phase, which means a lot of water demand. So we could use some significant rains in the next week to 10 days to keep everything on track. At this time of the year, that's always the tension between let's have dry weather so we can get the wheat harvested, to let's have some rain so we can keep the corn, beans, and milo in good condition.
Always seeking the balance there. So right to that, a cold front is to roll through Kansas later today and sparking rainfall, even some more severe weather perhaps.
Right. We do have a chance of rain coming in, and it's a fairly significant. We're looking at a 70 to 80% chance of that. The hope is that it is rain and not hail. The wheat is at the point where it would really be devastating to have the hail. We've already had a couple of major hail events in central and north central Kansas where as much as 80 to 90% damage was done to what had been very good wheat. So, again, rain without the hail would be totally, totally welcome. After that, it looks like we're in for another dry spell, but the quantitative precip forecast for the week, which goes from today through next Thursday, favors as much as 1.25 inches to 1.5 inches in the eastern parts of the state, basically from the Flint Hills eastward. The rest of the state, it starts tapering off, and by the time you get out into western Kansas, we're looking at maybe 1/4 to 1/2 inch of rain.
But it sounds like everybody will get something, or the potential's there.
The potential is there for everybody to at least see something, unlike the outlook for this week, which was basically most of the state didn't have much chance of seeing anything. So, again, it's a reasonably favorable outlook. If we go to the 8 to 14-day outlook, it still favors that warmer than normal temperature and drier than normal conditions. Again, we remind our listeners that drier than normal doesn't mean no rain. It just doesn't reach the threshold that we would expect at this time of the year. In eastern Kansas, that's 0.2 inches a day that would be anticipated. In western Kansas, it's more like 1/10 inch a day. But again, if you have 5 dry days, you're looking at trying to make up 1/2 inch of rain in the west and 1 inch in the east. So that takes quite a bit.
The question then comes up, if the balance of June will be warmer and drier, is that setting up for similar conditions for the remainder of the summer?
Not really certain at this point. The outlook for the July time frame won't be released until next week. But at this point, the more extended preliminary 3-week outlook, which does carry us through that first couple of days in July, favors a return towards neutral conditions, which means it's equally likely to be above or below normal and equally likely to be wetter or drier than normal. Problem that we get into as we go out to that extended outlook is that at this time of the year, most of our rains are fueled by convective events, which bubble up over an area and drop the rain, like we had with our Canopolis storm. And it's very difficult to predict exactly where that will be, whether it's on my field or it's across the road on yours. It's hard to tell.
That's summertime in Kansas, as we're well accustomed to it. Mary, we appreciate it. Thanks, and enjoy your weekend.
Thanks, Eric. You as well.
She's along with us each Friday to cover Kansas agricultural weather, research and extension. Climatologist Mary Knapp here on the broadcast. That is our time for today and the week. The best to you this weekend, and thanks for being along with us. Eric Atkinson for Agriculture Today over the K-State Radio Network.